Let me tell you something I learned the hard way, sitting alone with a tape running and a pencil wearing thin. The market doesn't beat you because you're stupid. It beats you because you don't know which side of your trades deserves your patience. Most men are quick to grab a small profit like a nervous clerk, snatching coins off the counter. But when the market turns against them, suddenly they become hopeful philosophers. Have you noticed that? Why is it so easy to take money from a good trade and so hard to take a loss from a bad one? Big losses begin the moment a trader stops listening to price, and that moment usually comes quietly. It doesn't come with panic at first. It comes when you glance at the chart and decide you already know what it should do. Have you ever noticed how easy it is to ignore a small warning when money is already on the line? That's when price starts talking and the trader starts arguing. Price never argues. It moves or it doesn't. It confirms or it denies. When a stock stops acting right, that's not an insult to your intelligence. It's information. The trouble is, most men treat information like an inconvenience. They see a break of support and say it's temporary. They see volume dry up and say it's just resting. They see momentum fail and say the news will fix it. Isn't it strange how flexible reasoning becomes once we're wrong? Every big loss I've ever studied started as a small, manageable one. The chart whispered first, then it spoke, then it shouted. The loss only grew because the trader stopped listening somewhere along the way. Instead of obeying price, he defended his entry. Instead of managing risk, he managed hope. And hope is deaf. It hears nothing the market says. A disciplined trader listens with his actions, not his thoughts. When price crosses a line that says the trade is wrong, he doesn't wait for confirmation from his feelings. He steps aside. That one habit keeps losses small and confidence intact. Because confidence doesn't come from being right, it comes from knowing you'll act correctly when you're wrong. The market will always give you a chance to be smart, but it only gives a few chances to be stubborn, and price keeps moving whether you're listening or not. Winning trades deserve time, not supervision, and that's one lesson most traders refuse to learn until it costs them real money. When a position starts moving your way, that's when your nerves wake up. You watch every tick, every bar, every small pullback as if it were a personal threat. Have you noticed how calm you feel when a trade is losing and how tense you feel when it's winning? A good trade doesn't need your constant attention. It needs your trust in the original reasoning. The chart already did the hard work when it lined up the trend, the volume, the timing. Once price confirms, your job is mostly finished. But instead of letting the market do its part, most traders interfere. They tighten stops too early. They take partial profits to feel safe. They turn a position trade into a scalp because waiting feels harder than acting. Supervision is often just fear dressed up as discipline. You tell yourself you're being careful, but what you're really doing is protecting yourself from the discomfort of unrealized profit. And unrealized profit is uncomfortable because it can disappear. Isn't it ironic that the very thing you're trying to grow is what scares you most? Big money is never made by watching. It's made by sitting. Trends unfold over time, not over emotions. A winning trade needs space to breathe, just like a losing trade needs a clear exit. When you overmanage strength, you turn opportunity into scraps. The market doesn't reward nervous energy. It rewards patience backed by preparation, and the man who understands that learns to step back once the trade proves him right, because strength doesn't need babysitting, and the more you hover, the more likely you are to step in at exactly the wrong moment when the trade is only doing what it's supposed to do while you're busy second, guessing every move and wondering why the biggest gains always seem to come you've already stepped aside. Bad trades feel comfortable because hope takes over, and comfort is dangerous in this business. The moment a trade goes against you, something strange happens inside your head. Instead of tension, you feel relief. Relief that you don't have to act yet. Relief that you can wait. Have you ever noticed how calm you become once you decide not to decide? Hope creates a false sense of control. You tell yourself the loss isn't real because it isn't booked. The chart may be breaking down, The volume may be confirming the move against you. But none of that feels urgent anymore. Why should it when hope is whispering that time will fix everything? And hope is very convincing when money is already committed. A bad trade doesn't hurt at first. It settles in like a familiar chair. You adjust your thinking instead of your position. Support becomes temporary weakness. Resistance becomes just noise. Risk becomes patience. Isn't it interesting how the language changes once you're wrong? Comfort is the enemy of discipline. When a trade is bad, it should feel uncomfortable. It should demand attention. It should force a decision. But hope dulls that edge. It tells you stories about past comebacks, about markets that overreact, about being shaken out too early. And while you listen, price keeps moving, indifferent to your reasoning. Professional traders learn to distrust comfort. They know that ease usually means avoidance. A losing trade should trigger action, not imagination. The moment you feel relaxed while holding a bad position is often the moment you've stopped trading the chart and started trading your emotions, because the market never offers comfort. It only offers information, and the longer you stay comfortable in a bad trade, the harder it becomes to accept what price has already been saying since the first sign that something wasn't acting right. The market punishes hesitation faster than ignorance, and that's a hard truth most traders don't like to admit. A man can be wrong and still survive, but a man who knows what to do and delays rarely does. Have you ever seen price hit your level, pause for a moment, and then run without you? That sting you feel isn't bad luck, it's the cost of hesitation. Hesitation usually comes from wanting certainty in a business that never offers it. You wait for one more candle, one more signal, one more bit of confirmation that never really changes the risk. While you wait, price is already making its decision. The market doesn't slow down because you're thinking. It moves when it's ready, and it leaves doubters behind without apology. Ignorance can be corrected with education. Hesitation is a character flaw. It shows up when the plan is clear but the nerve isn't there. You see the breakout, you know the setup, you've studied it 100 times, yet your finger freezes. Why? Because acting means accepting responsibility, and hesitation gives you an excuse. If you don't act, you can't be wrong, at least not officially. But the market keeps score even when you don't. Missed entries turn into chased trades. Chased trades turn into bad prices. Bad prices turn into losses that never should have existed, all because of a pause that felt harmless at the time. Decisive trading doesn't mean reckless trading. It means prepared trading. The decision is made before the moment arrives. When the time comes, you execute without debate. The trader who hesitates is constantly reacting, always late, always adjusting after the fact, while the trader who acts decisively accepts uncertainty up front and lets price sort out the rest, because in this game speed of obedience matters more than speed of thought, and the market has no patience for men who need to feel ready before doing what they already know must be done. Small losses are professional expenses, and that idea separates the operator from the gambler faster than any indicator ever could. Every business has costs. A store pays rent. A factory pays for materials. A trader pays with losses. The trouble starts when a man treats those losses like personal failures instead of operational costs. Have you noticed how emotional a small loss feels when you think it shouldn't have happened? A planned loss is not a mistake. It's proof that you respected risk before the market forced its hand. When you enter a trade, you're not predicting, you're participating. And participation always carries a fee. The professional accepts that up front. He knows that being wrong is not the problem. Staying wrong is. That's why he exits quickly and without ceremony when price tells him the idea didn't work. Amateurs argue with small losses. They widen stops. They average down. They look for reasons to stay because admitting a loss feels like admitting incompetence. But competence in trading isn't measured by how often you're right. It's measured by how cheaply you can be wrong. Isn't it strange how the men who fear small losses most are the ones who eventually suffer the largest ones? Small losses keep your judgment clear. They keep your capital liquid. They keep you emotionally available for the next opportunity. A trader who avoids losses avoids information. Because every loss carries feedback about timing, selection, or execution. When you cut a trade early, you preserve not just money, but confidence. The market rewards respect, and respect is shown through restraint. Paying a small loss without complaint is like paying admission to stay in the game. The trader who understands this doesn't flinch when a stop is hit. He records it, reviews it, and moves on, knowing that survival is the first requirement of profit, and that no account ever grew steadily without a long list of small losses quietly doing their job in the background while the trader stayed focused on process instead of pride. Big losses are emotional decisions, not market accidents, and they almost never happen in a single moment. They grow step by step, thought by thought, excuse by excuse. The chart doesn't suddenly attack a trader. The trader slowly stops defending himself. Have you ever looked back at a large loss and realized there were several clean exits before it ever got out of hand? An emotional decision usually starts small. You ignore a stop because the loss feels unnecessary. You tell yourself the market is being irrational. You decide to give it a little more room, just to be fair. Fair to whom? The market doesn't negotiate. It doesn't know your entry price, and it doesn't care about your reasons. Once emotion steps in, logic steps out, and price keeps moving. Big losses are built on attachment. You become attached to the idea, the analysis, the time you've already invested. The trade stops being a position and starts becoming a position you need to work. That's when the account becomes secondary to the ego. Isn't it interesting how the need to be right suddenly outweighs the need to protect capital? The professional trader feels emotion too, but he doesn't let it vote. His rules are in place specifically for moments when emotion shows up uninvited. When price reaches a point that says, wrong, he doesn't reinterpret the chart to soothe himself. He acts. That action cuts off the chain reaction before it becomes expensive. Big losses require participation. They require delay, justification, and hope. They require a trader to repeatedly choose comfort over control. The market only provides the opportunity. The trader provides the decision, and once emotion is allowed to guide that decision, the loss stops being about price movement and starts being about self-deception. Because the market never forces a man to hold a losing trade, it only waits while he decides whether protecting his pride matters more than protecting his account. Trends pay the patient, not the clever, and that lesson is written on every long chart if you're willing to look at it honestly. The biggest moves never come from brilliance in timing every turn. They come from recognizing direction and then having the restraint to stay with it. Have you ever exited a trade perfectly, only to watch the real move begin after you were already out? Clever traders like to outsmart the market. They predict tops, call bottoms, and pride themselves on being early. But early is often the same thing as wrong. The patient trader doesn't care about being first. He cares about being right enough to stay in. He waits for confirmation, accepts being late, and focuses on alignment instead of anticipation. Trends move slower than emotions but faster than expectations. They grind, they pull back, they shake weak hands, and they reward those who don't confuse normal corrections with failure. Patience in a trend means trusting structure over feelings. It means letting price action, not headlines or opinions, dictate whether the move is still alive. Isn't it curious how a trend feels obvious in hindsight, but unbearable while you're actually sitting in it? Cleverness seeks validation. Patience seeks results. A trader who needs to feel smart will constantly adjust, tweak, and interfere. A trader who wants to get paid will hold as long as the trend remains intact. The market doesn't hand out trophies for good analysis. It hands out profits for endurance. Patience doesn't mean passivity. It means active observation without interference. It means knowing when nothing needs to be done. That's the hardest skill to master, because doing nothing feels like losing control, even though it's often the exact behavior required to allow a trend to fully express itself. And the men who learn that lesson stop trying to extract money from the market and instead let the market deliver it in its own time, one swing at a time while they sit quietly and resist the urge to prove how clever they think they are. Overtrading is often disguised as hard work, and that disguise fools more traders than bad analysis ever will. Staying busy feels productive. Clicking buttons feels like engagement. Watching every tick and taking every setup feels like dedication. But have you ever noticed how exhausted you feel after a day full of trades that didn't really matter? The market doesn't pay by the hour. It pays for judgment. Overtrading usually comes from the need to feel involved. When nothing is happening, the trader feels useless. Silence on the chart feels like opportunity slipping away. So he manufactures action. He lowers standards. He trades marginal setups because waiting feels like wasting time. Hard work in trading happens before the market opens and after it closes. It happens in preparation, review, and discipline. During market hours, the real work is restraint. Knowing when not to trade is more valuable than spotting 100 average opportunities. Isn't it strange how men will risk capital just to avoid boredom? Overtrading also feeds emotion. The more trades you take, the less each one matters, and the easier it becomes to ignore risk. Losses blur together. Wins feel smaller. Judgment weakens. The account starts to reflect activity instead of intention. A trader who is always in the market is rarely aligned with it. Professionals wait. They wait for clarity, for structure, for conditions that justify risk. They understand that capital is a tool, not something to be constantly deployed. The market will always be open tomorrow, but capital once lost doesn't come back on schedule. The most dangerous phrase in trading is, "I might as well," because that's the voice of impatience pretending to be effort. And once trading becomes a way to feel busy instead of a way to express discipline, the account slowly bleeds from 1,000 small decisions that felt justified in the moment, but were really just noise dressed up as work. The market rewards obedience to price, not confidence, and that truth humbles every trader sooner or later. Confidence feels powerful. It feels like control. It feels like certainty, but the market has no use for how sure you feel. Have you ever been absolutely convinced about a trade that went straight against you? Price is the final authority. It doesn't need your agreement. It doesn't respond to conviction. It simply moves. The trader who survives understands that his job is not to impose belief, but to respond to behavior. When price confirms, he participates. When price denies, he steps aside. Confidence that ignores price becomes stubbornness, and stubbornness is expensive. Many traders confuse confidence with discipline. They think believing harder will make the trade work. But discipline is quiet. It shows up in execution, not emotion. Obedience means following the plan even when it contradicts your opinion. Especially when it contradicts your opinion. Isn't it telling how the hardest trades to manage are the ones you feel most certain about? The market constantly tests obedience through small violations. A level breaks by a little. A trend weakens just enough to be uncomfortable. Volume fades slightly. These are not dramatic signals, but they are honest ones. The obedient trader listens. The confident trader explains them away. Confidence wants to be right. Obedience wants to be aligned. One seeks validation, the other seeks survival. The market doesn't care which one you choose, but your account does. Every rule in trading exists to protect you from yourself. When price crosses a line you've defined, obedience requires action, not reinterpretation. The moment you start negotiating with price is the moment you've placed your ego above your capital, and the market has a long history of collecting the debt patiently, one trade at a time, while the trader convinces himself that confidence is strength, even as price continues to prove otherwise without ever raising its voice. Survival comes before profit, and any trader who learns that late pays for the lesson with real money. The market offers opportunity every day, but it only rewards those who are still standing to take it. Have you ever noticed how traders talk about the trades they missed, but rarely about the accounts that disappeared? Profit is a result, not a starting point. Before you can make money, you have to avoid losing it in ways that take you out of the game. That means respecting risk when it feels unnecessary, and stepping aside when the market isn't clear. Survival isn't exciting. It doesn't feel like progress. But it's the foundation everything else rests on. Many traders blow up not because they lack skill, but because they press too hard too early. They size up before consistency shows up. They trade aggressively before they've proven discipline. They treat capital like a score instead of a resource. Isn't it strange how men will risk their entire account trying to prove they can trade? A surviving trader thinks in terms of sequences. He knows one trade doesn't matter, but a string of bad decisions does. He sizes positions so that no single mistake can end his career. He keeps losses small not because he's afraid, but because he understands longevity. Time is an edge in this business, and you only get to use it if you're still here. Survival also protects your mindset. A trader who isn't under pressure thinks clearly. He follows rules. He waits. Desperation clouds judgment faster than ignorance. When your back is against the wall, every trade looks like a solution, and that's when discipline collapses. The market doesn't demand heroics. It demands respect. The trader who prioritizes survival doesn't chase, doesn't force, and doesn't need every move, because he knows the next opportunity is worthless if he doesn't have the capital, the confidence, and the emotional stability to take it when it appears. Let the market close your winners, not your fear, because fear has a habit of ringing the register far too early. The moment a trade moves in your favor, fear starts whispering about what you might lose instead of what the trade is showing you. Have you ever exited a position just to feel relief, only to feel regret minutes later as price kept moving? Fear doesn't read charts. It reads your emotions. It sees unrealized profit as something fragile that needs protection, even when the trend is strong and structure is intact. The market, on the other hand, closes winners with logic. It closes them when momentum fades, when price breaks character, when the reason for being in the trade no longer exists. Those two exits are not the same. When fear closes a trade, it's usually reacting to noise. A small pullback, a slow candle, a pause that feels uncomfortable. But trends breathe. They don't move in straight lines. If you demand constant progress, you'll never stay long enough to benefit from real movement. Isn't it curious how traders give losing trades endless patience, but rush profitable ones out the door? Letting the market close your winners requires trust. Trust in your analysis. Trust in your process. Trust that you don't need to extract every dollar with your hands on the wheel. The best exits often happen not because you felt something, but because price told you something. That requires observation, not intervention. Fear wants certainty. The market offers probability. When you exit based on fear, you trade your plan for comfort. When you exit based on price, you allow the trade to fulfill its potential or disprove itself honestly. One approach builds consistency. The other builds frustration. Professional traders learn to sit through discomfort on winning trades because they know that comfort is not the goal. Alignment is. They accept that profits fluctuate before they mature, and that the market has a better sense of timing than their emotions, because fear will always ask you to take less than the market is willing to give, and the trader who listens to fear never really finds out how much a good trade was capable of becoming before it was cut short simply to make the feeling go away. Small wins and big losses are not a market problem. They are a habit problem. They come from treating profits like accidents and losses like long-term investments. When a trade starts working, you get afraid it might stop. When it starts failing, you get convinced it must come back. Isn't that backwards thinking for a man who claims to read charts? The chart is already talking to you before the loss grows. It tells you when the line breaks, when momentum fades, when price no longer acts right. The trouble is, you don't listen because you're busy protecting your opinion. And opinions are expensive in this business. Why defend a trade that can't defend itself? A professional approach is simple, though not easy. You decide where you're wrong before you ever enter. That price is not a suggestion, it's a command. When it's hit, you step aside. No arguments, no second chances. That single habit alone keeps losses small, and small losses are the rent you pay to stay in the game. Now about those small wins. They stay small because you never give them room to breathe. You micromanage a good position as if it were fragile, when strength is the one thing that deserves time. Trends don't pay you in minutes, they pay you in persistence. Have you ever noticed how the big money is made by sitting, not trading? The market rewards discipline, not activity. It rewards men who think in terms of series of trades, not single outcomes. And if you don't learn that lesson early, the market will keep charging you tuition, quietly, trade by trade. Hope is not a trading strategy, and the moment hope takes the wheel, the trader steps into dangerous territory. Hope feels harmless. It feels patient. It feels optimistic. But have you ever noticed that hope usually shows up only after the plan has already failed? You never need hope when a trade is acting right. You need hope when it isn't. A strategy is built before the trade. It has rules, levels, and consequences. Hope is built after the trade goes wrong. It has no structure, no limits, and no exit. When a trader replaces a stop with hope, he hasn't changed the market, he's changed his responsibility. Instead of managing risk, he's waiting for relief. Hope tells you stories. It reminds you of past recoveries. It points to similar setups that worked before. It convinces you that this time is different. Isn't it strange how convincing hope becomes when admitting a mistake feels more painful than the loss itself? The chart may be breaking down, but hope keeps your eyes focused on what might happen instead of what is happening. The market doesn't respond to hope. It responds to order flow, supply, and demand. Price doesn't pause to give you a second chance because you're optimistic. Every candle that prints against your position is new information, and hope filters that information until it no longer resembles reality. Professional traders don't eliminate hope, they sideline it. They don't allow it into decision-making. Their exits are mechanical, not emotional. When price reaches a point that invalidates the trade, they act, even if hope says to wait. Especially if hope says to wait. Hope feels like patience, but it isn't. Patience follows a plan. Hope ignores one. One keeps losses small and capital intact. The other stretches losses until they become something you can't easily walk away from. Because the longer hope stays in control, the more the trade stops being about price and starts being about avoiding the discomfort of admitting that the market already answered. A question you didn't want to hear. The chart tells you you're wrong long before the account does, but only if you're willing to listen without argument. Price doesn't hide its intentions. It shows them in structure, in momentum, in the way a move either follows through or fails. Have you ever stayed in a trade simply because the loss still looked manageable, even though the chart had already turned against you? An account balance reacts late. It reflects damage already done. The chart, on the other hand, reacts in real time. A failed breakout, a loss of support, a change in character. These are early warnings. They're not dramatic, but they're honest. The problem is, most traders wait for pain before they act. By the time the account feels it, the chart has already been speaking for a while. When a trade is right, price behaves smoothly. Pullbacks are controlled. Momentum returns quickly. When it's wrong, price hesitates, struggles, and starts violating levels it shouldn't touch. That's not randomness. That's information. Isn't it interesting how traders will study charts for entries, but ignore them when it's time to exit? The chart doesn't care how much you risked or how confident you felt. It only reflects participation and rejection. When the market rejects your idea, the chart shows it first. The disciplined trader respects that signal. He doesn't wait to see how bad it can get. He responds while the damage is still small. Ignoring the chart is a form of denial. You shift focus to news, opinions, or time. You tell yourself it just needs space. But space without structure is just time spent being wrong. The chart isn't there to make you comfortable. It's there to keep you informed. A trader who learns to exit when the chart says no preserves capital, clarity, and confidence. He understands that exits are not failures, they are corrections. And the sooner those corrections are made, the cheaper they are, because the market always gives information before it gives consequences. And the only choice a trader ever really has is whether to respond to the message or wait until the lesson arrives in a form that's much harder to ignore.